Monday, October 23rd, 2023, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the Federal Reserve and how, in my opinion, they're going to succumb to pressure, the pressure of the bond market, and especially the 10-year yield. Am I saying they're going to pivot and start doing QE? Not exactly, and that's what I wanted to cover today. But before, I'd like to make a few announcements. The first one is to thank all of you again for your interest in the channel, and to make sure as well that you make sure that if you watch my videos but haven't subscribed yet to the channel, that you do. We're approaching 100,000 subscribers. It's been slow this year in terms of the new subscribers, so make sure you subscribe and also hit the little notification bell. I make a video every day, and yeah, make sure you hit the like button as well if you enjoy my content. And the other announcement I'd like to make is that yesterday we had the first round of the Argentinian presidential election, which has kind of gone off the radar right now with what's going on in the Middle East. But I think a couple of months ago there was the primaries, and Javier Milei, who's like a anarcho-capitalist, and the mainstream calls him a right-wing radical. Unfortunately, he didn't win in the first round. He came second to the mainstream candidate, Sergio Massa. He got 36% of the vote, and 36.5%, and Milei got 30%. So there will be a runoff on November 19th. So that will be interesting. And why? Well, because Milei's platform is trying to cut down the size of government, cut down the bureaucracy, and move Argentina more towards small government, free market economy. We'll have to see what happens, but I thought it'd be interesting to let you know, because a month and a half or so ago, he was all over the news, Milei. And of course, this has been now the election's probably been a bit overshadowed by what's happening in the Middle East. But I think we need to keep an eye on this. So, the Federal Reserve, and it's not just the Federal Reserve, I think, that is going to succumb. There's already pressure from the so-called mainstream economists who work for the banks, of course. The banks are also in trouble because they emulate what the central banks do. They hold a lot of government bonds, they hold a lot of mortgage debt, and all these are losing value at the rate of knots. The only reason they're staying solvent, the banks, is that regulatory-wise, they're able to mark a lot of these securities to maturity. They don't have to take any losses. But we've seen how when depositors get nervous, that might not even be enough to keep the banks solvent. We saw that in March with Silicon Valley Bank and First Republic and others. So it's, as I said, it's not just in the US. Here in the UK, we're seeing, as I said, economists urging the Bank of England actually to basically stop selling more of the longer-term gilts and mortgage debt that they have, because it's putting a huge hole in the Bank of England's balance sheet. And guess what? The UK Treasury is having to, basically pay the Bank of England for those losses. I mean, we, the taxpayer, are having to basically finance the Bank of England, which is something that they did very sneakily back in 2009 when they launched QE. They launched a limited company called Asset Purchase Program Limited that actually, when it makes money, it sends money to the Treasury. But now that rates are going to levels no one expected, and QE is becoming a disaster the consequence of QE is becoming a disaster, we're paying for it. So this article here that was published, I think on Saturday on Bloomberg says economists urge BOE to rejig bond sales after market rates spike. Yields on 30-year bonds have surged to the highest level since 1998. Sales from BOE's stimulus portfolio lock in taxpayer losses. So yeah, we're getting lumbered with these losses. It's not enough that we're paying the most taxes in 70 years. It's not enough that they're taxing us through inflation. Well, they have to taxes as well for their losses. It's outrageous. That's why I keep saying, unless we get rid of central banks, do we have a central bakery? Do we have a central supermarket? No, we need free markets. But unfortunately, that's something that right now many people are not thinking about. So let's quickly look at the 30-year bond yield today for the UK. This market has just opened, and yes, it's up another 10 basis points. It's at 5.2. So Bank of England continues to lumber taxpayer with losses. So this is what they say here. UK economists are urging the Bank of England to halt sales of long-dated bonds under so-called quantitative tightening after a collapse in bond prices threatened to lock in billions of pounds of losses for taxpayers. Analysis by Lloyds Bank and Bloomberg showed that active sales of gilts held by the BOE's balance sheet alone have cost the UK government, well, that's us really. Governments don't have any money. They have to extract this from the private sector. 15 billion pounds or $18.2 billion in the past year, with the bulk of the losses on bonds dated 20 years or longer. So I'm not going to go through the whole article. You can see here all the losses, the cumulative losses that they're incurring. What these people are saying is that they should do what's called Operation Twist, kind of focus the sales more on the short end of their portfolio. Short end means pay more like 5-year or 10-year, because the losses that are on the books for the longer end are bigger, because longer term bonds they react much more significantly to higher yields because there's a longer period of time to go. So let's say a 30-year bond is trading at half its value. A 5-year will probably be trading, let's say, at 80% of its value. So what they're saying here is that the Bank of England needs to focus on selling more shorter end, but that would also probably put pressure on shorter term rates. So eventually, I think what will happen, because this is kind of yield curve control, I would say, for the longer end, because if they stop selling the 30-year or even the 10-year, yields are going to be capped, and eventually they'll start doing QE again. And I think that's what will happen, and that's what the Bank of Japan has been doing. And now moving over to the Fed, what's going on vis-a-vis the Fed? Well, there are people like Zoltan Pozsar, who used to work, of course, for Credit Suisse. Credit Suisse, of course, is no more. It's been kind of taken over by UBS, but Zoltan seems to think that the Fed needs to do Operation Twist or even yield curve control. And yield curve control is basically QE. They don't call it QE, but look at the Bank of Japan. They've been increasing their balance sheet by hundreds of billions of dollars, not yen. So this is what Zoltan's latest missive is, and this is from a guy called Gary Hobold on Twitter or X, and he says this is important. Zoltan believes the Fed will be forced to announce yield curve control by year end. And I would say that's ultimately the road back to QE. So it says here, this is Zotan, just as war is becoming more entrenched as a macro theme, the Fed continues to do QT, quantitative tightening, and do so, it does the precise opposite of war finance in commodity choke points and QT. I noted that the Fed would have to restart QE sometime during the summer of 2023. And according to page 6 of this report, the amount of government debt that will need to be absorbed by private sector in 2023 is larger than at any time outside of world wars. So this is another reason why yields are rising so much. And right now, as I speak here, the 10-year yield is approaching 5%. It's up another 6 basis points. The high has been just below 5%. It's been 4.99. The 2 years at 5.12. That curve continues to re-steepen. Pretty soon is going to be flat, i.e. the 2-year and the 10-year are going to be at the same level. And historically, that has been a signal for trouble or for recession. But let's continue with Zoltan. Yes, there is $2 trillion in the overnight reverse repo facility. Well, I think it's almost down to 1 now. To absorb the treasuries to come. But treasuries will have to cheapen a lot relative to OIS, tighter swap spreads, to bring in RV funds, which won't run positions larger than 25 billion each, so they won't have to report their positions. Banks are unlikely buyers too, as they hold lots of underwater bonds in held-to-maturity books. And with their reserves down, they're closer to tapping and funding market than funding the Treasury through AFS books. FX hedge buyers are also unlikely buyers too. Don't worry about all these terminologies. The gist of this is that, yeah, there's not, they're running out of buyers. So anyway, let's keep going. As they got priced out. And the BOJ will soon feed them duration at home. And as Brad Setzer showed, geopolitical events last year have fundamentally reshaped global financial flows and reduced large FX reserve managers' appetite for U.S. Treasury debt too. Well, that means, Japan, China, and others, they're moving away from the dollar totally. I mean, they're not. They still have dollars, but they're trying to deal with their own currencies themselves, so they don't need to hold dollars. And we've seen that they've been hoarding treasuries, and they're buying less and less. So if the classic marginal buyers won't buy, who will? If there is a sell-off in equities, credit, and emerging markets, risk sellers would buy treasuries. But if there's not a sell-off, the lack of classic marginal treasury buyers means that treasuries will be at risk of tailing at auctions. Well, what does that mean, tailing at auctions? It means that there won't be that much demand at auctions, and that's really bad for the market. There will be not enough support during auctions by the U.S. Treasury, which in turn would drive sell-offs in equities, credit, and emerging markets. Thus, my sense is that this is a checkmate-like situation. The Fed won't be a pivot, and the terminal rate may have to go higher still, neither of which augurs well for either risk assets sell-off then into treasuries, or treasuries rate sell-off, then risk sell-off, then into treasuries. Hot wars in cold places and cold wars in hot places need war finance, not QT. There is a solution to the poor demand for treasuries, which is QE under the guise of yield curve control, which my instinct says will come by the end of 2023 to control where US Treasury trades versus OIS. So there you go. I agree with Zoltan. Yield curve control, as I said, is just another euphemism for QE. And I think that's why gold and silver have been so strong, apart from the geopolitical situation, because it smells that the Fed will need to do something different, kind of a pivot. And eventually, we just need to keep an eye on the Fed's balance sheet, and that will tell us everything. Don't listen to the mainstream media. And there's someone else here, I think, what's his name? Luke Groman. He's saying that the Fed is going to have to do the same thing. They're going to have to step in because, yeah, it's disastrous, the bond market situation. And if you look at the 10-year yield, the technical picture looks very bullish, not for bond prices, but for yields, which is a bad thing. And unless the Fed steps in, we could see 10-year yield above 6% next year, and I don't think they want that to let that happen. So with that, let's quickly look at where the markets are. And the other thing I would say, I've shown you some of the charts. I did a video on Saturday. Gold is looking really bullish versus treasuries, not only the 10-year, but the 2-year. And I think more and more people are going to realize that the U.S. Treasuries are not a safe haven anymore. They're not they're not risk-free, anything but. And the other thing that yield curve control, or i.e. QE, might do is that it will put a rocket up even more, the gold and silver price and other commodities, because it will mean that the Fed will have succumbed to pressure, and they'll start printing again, because that's the only thing they can really do, because we have a fiat currency system. If they don't print, the whole system implodes, because it will be impossible for not just the U.S. Treasury, but for consumers and corporations to keep carrying the debt load. So 8:22 a.m. London time, we've got spot gold down about $5. We're trading around 1976. Yes, it came off on the open overnight. I think things need a breather once in a while. I'm still, as I said, I'm still trying to stack. I'm trying to hold on. I've gone back a little bit into the miners. But anyway, the low has been 1964. The high is 1981. Silver, that was hit hard on the open. I think it traded, well, my system is saying it traded down to 22.68. I'm not sure it did. It's down 14 cents right now at 23.22. And I think the gold-silver ratio needs to go back below 80 for silver to start outperforming. Silver was able to close last Friday just above the 50-week moving average, which should be around 23.30. High's been 38. The low on my system is 22.68. I'm not sure if that's right. What about the stock market? Well, the Dow futures is virtually unchanged. NASDAQ is up 18. S&P futures up 2. Currencies as well are fairly quiet right now. The pound is unchanged, 121.64. The euro is at 105.85, down slightly. Dollar, dollar's been capped versus the yen. I bet you the Bank of Japan, as you can see this chart here, it doesn't look normal, this chart. I think they're basically capping the dollar. They're selling probably treasuries, and then getting the proceeds, which is dollars, and then selling those dollars and buying the yen. So we need to keep an eye on this. We're at 149.91. If we break through 150, which means the yen weakens, we could see treasury yields go up even more, because the Bank of Japan would have to sell more treasuries to keep their currency from dropping even further, or keep the dollar from rising even further. The yuan is unchanged. The dollar is unchanged at 732.34. To the other currencies, Aussie dollar is down a tenth, 63.07. The dollar is up slightly versus the Canadian dollar, 137.22. Kiwi dollar is down slightly at 58.22. To the general commodities, we got WTI crude down 1%, trading at 87.08. Brent is down 0.75% at 90.50. And platinum is down $3, trading around 895. High-grade copper is down 0.2%, trading at 356. We've looked at the bond markets already, so I won't go through them again. Suffice it to say, keep an eye on the 10-year yield. You can find it on investing.com. If you go under markets, and then you go under bonds, and then you click on US Treasury yield curve. It's very easy to keep track of it. So with that, I'm going to wish you all a very good start to the week and a very good day. Take care. Bye.